Certuvo, your exam partner.
Hello and welcome. I'm Brittany, your instructor for this CMA Part 1 course, and I'll be guiding you through the full course step by step. In this module, we'll be covering accounting for income taxes and revenue recognition, an important area of financial reporting that focuses on how companies recognize, measure, and report income-related items in the financial statements. We'll begin with accounting for income taxes, where you'll learn how differences between accounting income and taxable income affect reporting and why those differences matter. We'll then move into revenue recognition, where we'll look at when revenue should be recorded, how performance obligations are satisfied, and why timing is so important in presenting accurate financial results. Together, these topics will help you build a stronger understanding of financial reporting concepts that are essential for success in CMA Part 1. The key areas we will focus on are timing of income recognition, deferred tax accounting, performance obligations, and CMA exam applications. So, from the beginning, I want you to keep one major idea in mind. Both income taxes and revenue recognition are deeply connected to timing. For income taxes, we are asking, when is income recognized for books and when is it recognized for tax purposes? For revenue recognition, we are asking, when has the company actually earned revenue under GAAP? So the question is not only how much, the bigger accounting question is often when. Let's move to Slide 2. Slide 2. On Slide 2, we begin with the lecture objectives. By the end of this lecture, you should be able to explain the purpose of deferred tax accounting and the asset liability method. You should also be able to distinguish temporary differences from permanent differences and explain deferred tax assets and deferred tax liabilities. The slide also tells us that we will explain when revenue is recognized over time or at a point in time, and how performance obligations affect that decision. Finally, this lecture prepares you to apply long-term contract revenue recognition logic and answer CMA-style questions on both income taxes and revenue recognition. So this is not just a definition-based topic. It is a timing, classification, and exam application topic. As we go through the lecture, keep asking yourself, what is being recognized? When is it being recognized? And does that timing create a future tax or revenue effect? Let's move to Slide 3. Slide 3. Slide 3 is titled, Why These Topics Matter. The slide says, both of these topics are fundamentally about timing. For income taxes, the timing issue is when income is recognized for books and when income is recognized for tax purposes. For revenue recognition, the timing issue is when a company has actually earned revenue under GAAP and whether control has transferred or the performance obligation has been satisfied. The key idea on the slide is very important. In both areas, the biggest question is not just how much, but when. This sentence is really the foundation of the whole lecture. A company may receive cash today but recognize revenue later. A company may report income for book purposes in one period but pay tax on it in another period. So accounting is not only measuring amounts, it is also placing those amounts into the correct reporting period. Let's move to Slide 4. Slide 4. Now we begin the first major part of the lecture, accounting for income taxes, big picture. The slide explains that income tax accounting compares two different measures of income. First, we have book income, which is recognized under GAAP financial reporting standards. Second, we have taxable income, which is recognized under the tax code for tax filing purposes. These two amounts can be different, even for the same company and the same year. The slide then explains that deferred income tax accounting is really inter-period income tax allocation. That means income tax expense should be allocated to the correct accounting period, even if the actual tax payment happens in a different period. The key point on the slide says, the company may want to pay one tax amount based on book income, but need to pay another amount based on taxable income. That difference between book income and taxable income is where deferred tax accounting begins. Let's move to Slide 5. Slide 5. Slide 5 introduces the asset-liability method. The slide states that the asset-liability method is the proper method for accounting for income tax timing differences. Under this method, deferred tax assets and liabilities are formally recognized on the balance sheet. These assets and liabilities reflect the future tax consequences of current period differences. And, very importantly, they arise from temporary differences between financial statements and tax returns. The key idea on the slide is timing differences create future economic effects, so those effects must be recognized as assets or liabilities. So the company is not only asking, what tax do we pay now? It is also asking, what does today's difference mean for future tax payments? If today's difference creates a future benefit, we may have a deferred tax asset. If today's difference creates a future obligation, we may have a deferred tax liability. Let's move to Slide 6. Slide 6. Slide 6 explains temporary differences. The slide says that deferred taxes arise because of temporary timing differences between book and tax reporting. A temporary difference exists when an item is recognized in both book income and taxable income, but not in the same period. That is the key phrase, recognized in both systems, but at different times. The slide also says there is different timing. The item appears in one system earlier and in the other system later, creating a gap between the two. And finally, the slide says temporary differences will reverse over time. That reversal is what makes them temporary. So when you see an exam question, ask yourself, will this item eventually appear in both book income and taxable income? And will the timing difference close later? If yes, you are likely dealing with a temporary difference. Let's move to Slide 7. Slide 7. Slide 7 now explains permanent differences. A permanent difference occurs when an income or expense item is recognized for book purposes only, or tax purposes only, but not both. The key rule on the slide is very important. Permanent differences do not give rise to deferred tax assets or liabilities. Why? Because there is no future reversal. The difference does not move from one system to the other later. It is permanent. The slide gives common examples, such as municipal bond interest, which may be recognized for book purposes but exempt from federal taxation. It also mentions non-deductible expenses, where certain expenses are recognized for books but are never deductible for tax purposes. And it includes tax-exempt items, which are permanently excluded from taxable income under the tax code. So remember the exam rule. Temporary differences can create deferred taxes. Permanent differences do not. Let's move to Slide 8. Slide 8. Slide 8 compares temporary versus permanent differences. For temporary differences, the slide emphasizes that the item is recognized in both systems, but with different timing. It reverses later, and it can create deferred tax assets or deferred tax liabilities. For permanent differences, the item is recognized in only one system, or it never reverses. Because it does not reverse, it does not create deferred taxes. The exam point on the slide is especially important. Students must be able to identify whether an item is temporary or permanent before deciding whether deferred taxes apply. This is the correct order of thinking. First, classify the difference. Then decide whether deferred tax accounting applies. Then determine whether the result is a deferred tax asset or deferred tax liability. Let's move to Slide 9. Slide 9 explains the core logic of a deferred tax asset. The slide says, a deferred tax asset is created when taxable income in the current period is greater than book income in the current period. Let's slow that down. If taxable income is greater than book income, the company pays more tax now than book accounting suggests it should. That means the company has effectively paid tax early. And because paying more tax now creates a future tax benefit, the company records a deferred tax asset. The slide gives the simple logic. paid too much now leads to benefit later leads to deferred tax asset. This is a very useful exam shortcut. If the company pays more tax now because tax recognition happens before book recognition, think deferred tax asset. Let's move to Slide 10. Slide 10. Slide 10 explains the opposite situation, deferred tax liability. The slide states that a deferred tax liability is created when taxable income in the current period is lower than book income in the current period. In other words, the company is paying less tax now than its book income suggests. That creates a future obligation because the tax has not disappeared. It has only been delayed. The slide gives the simple logic. Paid too little now leads to owe more later leads to deferred tax liability. So if the company gets a tax benefit now that will reverse in the future, it records a liability. A good way to remember this is deferred tax asset means future tax benefit. Deferred tax liability means future tax obligation. Let's move to Slide 11. Slide 11. Slide 11 is titled How to Think About DTA versus DTL. This slide gives us a very useful comparison for exam questions. If tax now is greater than book tax now, then book-based tax expense is lower than taxes actually payable now. That creates a deferred tax asset. If tax now is less than book tax now, then book-based tax expense is higher than taxes actually payable now. That creates a deferred tax liability. The slide summarizes it this way. If you have already paid more than your books say you owe, you have a future benefit, which is an asset. If you have paid less, you have a future obligation, which is a liability. This is one of the easiest places to make a mistake on the exam. So when you are unsure, ask, did the company pay too much tax now? Then think asset. Did the company pay too little tax now? Then think liability. Let's move to Slide 12. Slide 12. Slide 12 gives examples of a deferred tax asset. The slide says a deferred tax asset can arise from two common situations. The first is taxable revenue now, book revenue later. An example is a contract liability or advance payment. The company may be taxed when cash is received, but it recognizes book revenue later when the performance obligation is satisfied. The second situation is book expense now, tax deduction later. An example is assurance warranty expense. The company recognizes the warranty expense for book purposes now, but it may only deduct the amount for tax purposes when it is actually paid later. In both situations, the company pays more tax now than its current book income requires. That creates a future benefit. Therefore, it creates a deferred tax asset. Let's move to Slide 13. Slide 13. Slide 13 now gives examples of a deferred tax liability. The slide says a deferred tax liability can arise from two common situations. The first is book revenue now, taxable revenue later. That means revenue is recognized for books in the current period, but it is not yet taxable. So tax will be owed in a future period. The second is tax deduction now, book expense later. The classic example on the slide is accelerated depreciation for tax versus straight-line depreciation for books. In the early years, accelerated depreciation gives a larger tax deduction. That reduces taxable income now. As a result, the company pays less tax now. But that benefit reverses later. So early tax savings create a deferred tax liability. The slide also reminds us that accelerated depreciation is one of the most commonly tested deferred tax liability scenarios on the CMA exam. Let's move to Slide 14. Slide 14. Slide 14 gives a worked example, prepaid rent and deferred tax asset. The facts are, prepaid rent of $5,000 is received at the end of 20X1 for January 20X2. For tax purposes, the $5,000 is taxable in 20X1, the year it is received. For book purposes, it is recognized as revenue in 20-2 when the performance obligation is satisfied. Now the tax rate is 35%. So the deferred tax asset is calculated as $5,000 multiplied by 35%, which equals $1,750. The conclusion on the slide is tax is paid before book revenue is recognized leads to deferred tax asset of $1,750. This example is very useful because it connects both parts of today's lecture. The company receives cash now. Tax is paid now, but book revenue is recognized later. That timing difference creates a deferred tax asset. Let's move to slide 15. Slide 15. Slide 15 explains the reversal of deferred tax asset. The slide reminds us that temporary differences do not stay forever. They reverse when the item eventually affects the other reporting system. In Period 1, tax is paid on the advance receipt, and a deferred tax asset of $1,750 is recorded. In Period 2, book revenue is recognized. No tax is due because tax was already paid, and the deferred tax asset is reversed. The key point on the slide is when the revenue is recognized for books in the following year, but no tax is due because tax was already paid, the deferred tax asset is reversed to zero. This is the essence of a temporary difference. It creates a deferred tax effect now, and then that effect reverses later. Let's move to slide 16. Slide 16. Slide 16 explains the presentation of deferred tax assets and liabilities. The slide says deferred tax assets and liabilities are presented on the balance sheet as a net non-current asset or a net non-current liability. This means all deferred tax asset amounts are identified and totaled. Then they are offset against deferred tax liability amounts. The result is presented as one net figure. The key point on the slide is presentation is net, not always separate line by line. So even though there may be many individual temporary differences behind the scenes, the balance sheet generally shows a single net deferred tax asset or a single net deferred tax liability.